Hi, Ed here. David, Sara, and I will be back next week with a new episode of Energy versus Climate, all about natural gas use in homes with special guest Bruce Nilles of Climate Imperative. But until then, we'd like to share another podcast with you that we think might be of interest. ARC Energy Ideas explores the trends that influence the energy business, including political, environmental, technological, social, and economic forces. The show is hosted by Peter Tertzakian and Jackie Forrest of the ARC Energy Research Institute. Jackie and Peter have been thought leaders in the space for years. In fact, Peter joined us way back on episode 3 of Energy versus Climate to discuss the divestment movement. The ARC episode we'd like to share with you this week is entitled Canada Oil and Gas 2022, another bull run, but different, and another IEA report. In the episode, Peter and Jackie review the ARC Energy Research Institute's recently released Outlook for the Canadian Oil and Gas Economy for 2022, showing just how far things have turned around for the industry since April 2020. The episode also shows how differently revenue is being invested compared to previous booms, and digs into the IEA's most recent report reviewing Canadian energy policy. On the whole, ARC Energy Ideas covers similar topics to us here at Energy versus Climate, while offering a different perspective, one we hope listeners will find interesting and enlightening. Now on to the show.
The information and opinions presented in this ARC Energy Ideas podcast are provided for informational purposes only and are subject to the disclaimer link in the show notes.
This is the ARC Energy Ideas podcast with Peter Tertzakian and Jackie Forrest, exploring trends that influence the energy business.
Welcome to the ARC Energy Ideas podcast. I'm Jackie Forrest.
And I'm Peter Tertzakian. Welcome. Well, Jackie, I don't think we can get by this week without, again, talking about the price of oil. The price of oil, WTI, West Texas Intermediate in the United States, poked its head above $80. It's got an 8 in front of it now. And so that's significant. I think the last I looked, it was almost $83 US. And that has implications beyond being a psychological marker. It also has implications to what starts happening to the price at the pump, the demand side. Also has big implications for producers of oil and gas. And because Canada is the 4th largest producer of oil and gas in the world, it has big implications in terms of the local economy. And given that the local economy here in Alberta is 76% of Canada's oil and gas production, every dollar and certainly every $10 rise, like going from $70 to $80, has got huge implications in terms of the fiscal situation. So that's what we want to talk about today.
That's right. We're going to talk about, well, first of all, the outlook for oil and gas. And many of you know, issue our ARC charts each week. And so we want to introduce the financial metrics as we close out 2021, but also what we're expecting for 2022. So we'll talk about that. Then we'll talk about, well, we are in this high price cycle. And Peter, you just put out a commentary about what's different this time versus the past few high price cycles. So we'll go through, it does look quite a bit different in many ways. And I think that's worth talking about. And then I just want to finish off with this pretty high profile report that came out last week. The IEA released a report on Canadian energy, and they gave some recommendations to help Canada manage through the energy transition. So I wanted to talk a little bit about some of the recommendations, and I agreed with many of them. And so we'll talk about that as well.
It's all Canada energy. So let's start with what happened in 2021. We've just closed off that year. What were the oil and gas price averages?
We averaged $68 WTI in 2021 and $3.47 per gigajoule at AECO for the gas. So those are, quite high prices relative to where we've been for the last several years. They don't look high maybe now compared to where the prices are today, but they were very good and the industry was quite healthy. And I do want to say, I'm going to put a link to our latest ARC charts. And if you go to the very last page, you're going to see all these numbers. But for 2021, $158 billion in revenue. So that's basically if you take the production of the industry, multiply it by those prices, that's the kind of number that you get. That's an all-time record for revenue in all the years that the Canadian oil and gas industry has been in business. So that's pretty remarkable. And almost $89 billion of cash flow. And the cash flow is what's left over after you take that revenue, you pay your taxes, your royalties, your operating expenses, your expenses for people in Calgary and things like that. That's what's left over. This is before you go and spend money on capital.
I think this is a really big number, and we knew it was going to be big, but 158 billion in revenue. The last high water mark was 2014 at $144 billion. And so we've got $12 billion higher in revenue. The cash flow was about 67 billion in 2014. That was the last episode when we had $100 a barrel. And we've got 89 almost billion, $88.9 billion. I mean, these are just really big numbers that are going to percolate through the economy. But I think the big news is that, as you said, the price of oil averaged $68 last year. And this year, already we're above 80. So the numbers are going to be record-setting again with high likelihood.
I do want to point out one other thing before we move off 2021, though, is of this 89 billion, a fairly small part of it, 34 billion, went to capital spending, resulting in about 4,600 new wells drilled in Western Canada. So that's quite different. We'll talk about what's different from last time, but that really isn't a huge amount of activity. So that's the part that didn't reflect the higher prices and those high revenues and cash flows. So it doesn't feel quite like it did in 2014 because not as much of that money is going towards capital spending.
No, this is a very different era, and that's what we want to talk about. So why don't we do that? Why don't we talk about the differences between this high price era that we're entering versus sort of the high price eras of the past? And I'm thinking specifically of the year sort of 2007, when the price of oil went from the $50 mark. And then eventually by the 2008, 2009, it was into the $100 range. And then again, post-financial crisis and that 2000, I'm just guessing here, 13, 14 era, just before the big glut and the price war of 2014, 15. Again, there was just a lot of revenue that was generated in that era. So why don't we talk about the differences between then and now?
Okay, let's do that. So, one of the differences is higher output. People may not appreciate it. Since the 2014 kind of era, on average, that 2012 to 14 period, we have about 35% more production on a barrel of oil equivalent, if you can consider both gas and oil. Wow. So that's huge. So that's why, you at any given price, you're going to make a lot more revenue because you just have more units to sell.
So price times volume equals revenue, and the volumes are up 35% since that last high-priced era of 2011 to 14. So that just means that all else being equal, your revenues are 35% higher. And you have much more of a coupling, as I said, or much more torque to those price changes in the commodities, oil and gas, especially oil, because a large part of that output growth has been from the oil sands.
Exactly. Yeah. And it's actually the stronger commodity. At the end of this section, we'll talk a little bit about the outlook for 2022. Gas prices are not quite as high as the outlook for oil, but oil really is the thing that has the biggest impact on the revenues.
Now, the other big thing that's different from back then to today is the exchange rate. So back certainly in the 2007 to 10 era, and actually even in that the early part of the last decade, we were basically Canadian dollar at parity with the US dollar. And the Canadian dollar was very much considered a petrodollar, whereby it moved sympathetically up and down with the price of oil. And as the price of oil strengthened, the value of the Canadian dollar appreciated relative to the US. It's not happening this time. The Canadian dollar is stuck around, say, 80 cents. And it's just really not, it's moving a little bit as the price of oil appreciates, but really nothing like it has in the past. This has very profound implications as well on revenue because we get paid in US dollars. US dollars is the currency that oil trades under. So at higher oil price, you get 20% more Canadian dollars.
Yeah, that's a real difference. And if you even go back to 2007 and 8, do you remember that, Peter, when the Canadian dollar was actually a premium? That's when going to the States for holidays was a lot more fun and shopping in the US was a lot more fun. But for the Canadian producers, it wasn't great because they would sell their products in US dollars, and then only get 90 cents Canadian back or whatever. So this period is actually helping them out in that they get a bit of a local boost when they turn their money back into Canadian dollars. It's worth more. And so that's super helpful versus previous.
Yeah. So the other big difference here is market access. We've stopped talking about pipelines over dinner conversations, but market access was a big issue over the course of the last decade. With that aggressive production growth, of course, it put pressure on the pipelines, and periodically we had very deep discounts. So the producers were unable to really realize the full potential of the rise in West Texas Intermediate prices because the Canadian prices would be depressed or discounted relative to the US.
Yeah, and this was a real problem in that it's really in that 2012 to 14 era. Basically, the real problem started in 2012 when we grew our production so much out of Western Canada. Combine that with the fact, if you remember, that's when tight oil was taking off in North Dakota. And so that was, putting all this crude oil into the Midwest and Ontario, which is our main markets, and they were becoming oversupplied. And we actually had much lower prices through all of the inner part of the North America compared to at the coasts. And prices fell very quickly. At times, between 2012 and 13, we had a $10 or $20 discount, but there were times when it was even 50% greater. Mm-hmm. And I don't know if you remember this, but this is when Premier Ellison Redford blamed the bitumen bubble on the government's budget crunch. Because of that, we are forfeiting something like between $50 and $20 billion in revenue each year, and it resulted in lower royalties for the Alberta government. And that's when started to be real focus on lobbying for new pipelines at that time.
Right. And then rail started to come in as well. And so we are in a situation today where, with production growth having moderated, we've had Line 3 come on, TMX is on the way. There is rail capacity to take off any excess production, but that's really not forthcoming. And so we've got a situation where the price of Canadian oil relative to continental oil is trading at about normal in terms of its price differentials. And that means that the revenue is going to be strong in addition to the exchange rate phenomenon that we talked about, in addition to the production growth. So this is why we're going to be seeing tremendous amount of revenue in 2022 on the back of a record year in 2021. But that's not the only thing, because you talked about the cash flow, and revenue minus costs is cash flow. And so let's talk about those operating costs.
Yeah, operating costs are the biggest component of costs that producers have to pay out of their revenue, especially for the oil sands. There's just been a phenomenal change in the operating costs compared to that 2014 era, the last time we saw prices like this. We have data from CAP and StatsCan that shows that the operating costs are down somewhere in the range of half of what they were back in that era. So it's a huge amount of change, and a lot of innovation and optimization has occurred in the oil sands to achieve that.
Yeah. So just to give you some sense of the numbers, it was almost $35 a barrel operating cost for a barrel of oil sands on average. And that has fallen to under $20, $15 to $20, and increasing optimization, the pursuit of decarbonization, because increasing efficiency lowers your carbon output as well, is driving these costs. Now, we haven't seen the same amount of cost reduction in the conventional non-oil sands of the business, but they too, the non-oil sands producers, are enjoying quite high revenue and cash flow as well, because they produce the lighter oils, and the lighter oils are not subject to the same quality discounts as the heavier grade bitumen.
So operating costs are a huge part of why, at a given price, there's more money to be made, because you're giving less to the operating costs, which is providing more free cash flow.
Mm-hmm. So cash flow, we've already talked about that. And when you have greater cash flow, especially in the oil sands, you have what's called payout of the oil sands projects comes much faster. So there's 2010, actually I'd go back to 2006-ish, 2006 to 2017 was really the era of very high spending on oil sands projects. And that era really ended starting around 2015, 16 with the price of oil coming down. And of course, all the environmental concerns and the ESG and all of that. So the investment, I think it was like 250 billion plus in that decade. Once it pays out, then all of a sudden the royalties go higher, substantially higher, because it's what's called post-payout. And a lot of those projects now are starting to pay out because the cash flow is much higher and the formulas are tied to the cash flow. So that, combined with the formulas on the conventional side of the business, and this is not only Alberta, I mean, you can go to BC, Saskatchewan, Newfoundland, Labrador, each one has a bit of a different royalty scheme, but the royalties from the industry are going to be much stronger than they have been over the course of the last half dozen years.
Yeah. So the Alberta government had done a midterm update around their fiscal year that ends in March of 2022, and they were expecting about 11 billion for the fiscal year ending in March of 2022. I expect the actual number will come in higher because oil prices since that has come out have been stronger, and Q1 looks like it's going to be quite strong. And I expect even higher numbers next year from Alberta. And that's really consequential. A lot of these provinces have spent a lot of money because of COVID and had been running deficits. So it will be really meaningful to see some increase in revenue for a lot of these provinces.
No, it's the, if you look at the total amount of revenue in Canada, I think back in 2020, the pandemic year, correct me if I'm wrong, it was less than $4 billion in royalties to all the producing provinces. And I think this year you're probably going to hit 17. Like, it's a dramatic
in 2022.
2022, yeah. It's a really dramatic increase. And that's going to put the producing provinces in a better fiscal position.
Now, shareholders are beneficiaries too, though.
Yeah,
they're the other ones that are getting some of this cash flow, as a lot of the companies are, instead of spending all that money on capital programs, they are giving more money back to shareholders. And if we look at our 2022 numbers, we estimate there's still about $55 billion left over after their CapEx spending. And some of that is going to go to debt repayments, but a big chunk of that is going to go to shareholders.
Yeah, I think this is one of the biggest differences ever in the 100+ year history of the oil and gas business. And it's not just the phenomena here in Canada, it's also happening in the United States, it's happening in the European multinationals, is that the incremental cash flows are not necessarily being reinvested back into the ground for more drilling, more facilities construction, and so on. And this, in part, is a consequence of divestment, ESG, climate change policy, et cetera, where the cash flow, if it is not reinvested back into the ground, if it's strong, then it goes back to the shareholders and the investors. So it's just really an amazing dynamic we have not seen in the history of this business, because, as I said, the paradigm of the business was you take your cash flow and you reinvest it back into the ground to grow production to satisfy increasing demand. The outlook is considerably different for oil consumption, oil policy, and so on. So now we have a situation where these companies, in times of high commodity prices, are just major generators of cash flow and therefore dividends and share buybacks.
Well, and just to put it in perspective, another implication to the Alberta and Western Canadian economy is we're not seeing as much happen here in terms of spending. So just, that ratio you talked about in the 2011 to 14 era, about 120% of the cash flow was being spent on CapEx. So not only were they taking all the money they generated from the industry as cash flow and spending it, they were spending even more. They were getting, debt or new equity. This year, we expect only about 40 to 45% or so to be spent in the Alberta economy. So to put that in perspective, back in that 2014 era, about $80 billion annually was being spent on capital projects, a lot of that in Alberta and in Western provinces. This year, we expect half as much is going into the local economy. So that's why it just doesn't feel like the boom that we experienced back in 2014, because you've taken like $40 billion less going into the local economy in terms of capital spending.
But you're right, Jackie. One of the things we're not seeing is the activity in the field. And so this is a very different dynamic than before, where cash generation then gets spent in the field and affects the rural economies where the drilling takes place. There isn't nearly as much of that going on now. The wealth generation is actually being distributed to the shareholders, of which there are a significant number in the local jurisdictions that are producing. But there's a lot of also shareholders that are outside of the jurisdictions and international holders of these stocks, like the big companies.
Mm-hmm. Yeah, for sure. So Some's going into the local economy through the individuals that are shareholders, but some is leaving. The other implication of this is it really has shrunk our oilfield service capacity. We just don't have the capacity that we had in that 2014 era. I think in that time, we talked about 4,600 wells being drilled in 2021. So if you go back to the 2014 era, there was about 11,000 wells drilled. So we have a much smaller oil field service capacity. In some ways, this reinforces high prices, right? Even if companies changed their mind and said, hey, we want to drill like back in 2014, I don't think it's possible in the short term to see that type of oil field service activity in Western Canada.
It won't happen. I mean, it just the prices are already inflating, not only here, but in the United States as well, in the oil field services. So the ability now to execute on drilling programs, expanded drilling programs, is just not there.
You can't grow like you were before. And here's one other implication of the higher cash flow, which is kind of interesting. We talked about, less spending in the local economy because companies aren't spending as much, but because they are making cash flow and paying dividends, they are taxable. When they spend all their money, then there's no profit left. There's no money left to tax. But when they don't, when they start to distribute it out to their shareholders, it actually is taxable. And so that can be helpful for federal and provincial revenues because there's more tax income there than there was in the past. And that can help some of those fiscal deficits.
Yeah. There's one more big difference between prior eras and today, and that is what I call the repatriation of influence, the buying out of multinational interests. So wind back 6-7 years, it was the start of the exodus of a lot of multinationals who wanted to get out of the oil sands, starting with the European multinationals like the Statoils. And, at the time, it was viewed very negatively that the multinationals were leaving. It was like a vote against Canada. They're packing up. They're not going to invest here anymore, so on and so forth. But if you actually now look at what has happened, where we have seen Canadian companies, Canadian domiciled companies, CNRL, Cenovus, Suncor dominantly, basically buying out the shareholdings of a lot of the big multinationals. What we have a situation is now the control of the cash flow is not in the hands of boardrooms that are outside the country. They're in the hands of the boardrooms that are in Canada and Calgary, basically. That is a really big dynamic, the implications of which have yet to be thought about.
Well, and this isn't the first time. Back in the 1990s, there was a similar period where, because of the low prices, companies like BP, Amoco, Texaco at the time, Marathon, sold their projects in Canada, and a lot of those assets went to Canadian companies.
Yeah.
And that allowed those Canadian companies to become more strong. In fact, that's how some of the biggest companies that are Canadian owned today came to be, because they picked up those crown jewel type assets that were being left by the foreigners when they left, and has allowed Canadian oil and gas company to be more profitable and strong. And I think this era has done the same. It's allowed those big Canadian companies to be more strong and more resilient.
Yeah, if you reflect, what you see is a pattern where the big multinationals come in actually when prices are high and activity is strong. They invest billions of dollars to develop out projects and infrastructure, and then they typically pack up and leave at the bottom of the market, and the consolidation happens amongst the Canadian companies. And I think that this cycle has repeated itself again over the course of the last half dozen years, and it's definitely resulted in a much more made in Canada oil and gas industry, as opposed to one that's been dominated by foreign interests.
Mm-hmm. Yeah, so I think that's positive. And like you say, today it's not resulting in more money going into the Canadian economy because a lot of the money is going to shareholders, but because a lot of those shareholders might be, more of them are Canadian, it is resulting in more money coming to Canadians.
Yeah.
So there's lots of differences why this bull run is different than last time around.
So if you look at the number of, say, 70, what's our oil price expectation for this year? 70.
Well, we're being conservative, and in our ARC charts, we actually have an outlook for 2022, and we're using $73 WTI and $3.20 AECO, and that's going to result in $173 billion, or a 10% growth in revenue, and that would result in almost $100 billion of cash flow, up 10% from last year. And we think that would result in the range of between 5,600 and 5,800 wells. So that's our outlook. You can see it on the charts there if you want to look at all the numbers. But it may turn out that that's conservative. It may be higher than that if prices hold in at the levels we're seeing.
173 billion as compared to 144, which was recorded in 2014. That's just a staggering number. And we'll just see where the numbers fall. But right now we're above $80 a barrel. That $73 a barrel expectation, it would have to average $73 over the course of the whole year. We're only a couple of weeks into January, but it looks like we're in for another strong year of commodity prices.
Mm-hmm. And therefore strong revenue and cash flows. Mm-hmm. Okay, well, let's turn to the last section of our podcast, which is this new IEA released report on Canadian energy. And just to give some context to the report, and I will put in, there's a video when they launched the report that you can look at. It's about an hour long. And then there's a link to the actual report, which is 261 pages long. Just to give you some context, the IEA regularly conducts in-depth reviews of energy policies of its member countries. Canada is a member country, and the last time they reviewed Canada was in 2015. And the goal is to provide some recommendations to help Canada effectively transform its energy sector in line with its net zero goals in this case. You know, the one thing I'll say about the document is it really is a great reference document. It has a chapter on everything Canadian energy. There's a chapter on electricity, oil, nuclear, coal. There's just a ton of background on the policy and the metrics around the industry. So, you know, I just have you just be aware of that. If you're ever looking for facts or figures or what the latest policy is, it's actually a really great resource for that. And it's got a lot of history as well. In terms of where the recommendations came from, they did interview people from major industry associations, government agencies. And so, you know, I felt it overall was pretty well informed. You know, it wasn't just a bunch of folks in Paris that didn't know too much about what was going on in Canada. I think it was really well done in terms of they knew what was going on.
Yeah, I agree. It's a good report. It's worth reading. Definitely worth reading if you're in the business or financing the business or in the periphery of the business. I would say that there's a lot of these sorts of reports coming out that are, of course, talking about the industry 2030, 2040, 2050, and that's all fine. But we've got a situation here right now where we are in another bull market with strengthening oil prices, strengthening gas prices, geopolitics, and all sorts of issues. And I think there needs to be more thought put into the near term now rather than philosophizing about the long term. Now, I'm not saying don't strategize, don't think about long-term issues. You need to do that. But, you know, there's some pretty serious energy-related issues with respect to oil and gas that are, I think, going to provide considerable volatility across the broad economy over the course of the next couple of years. We talked about that in our last podcast. And major changes in commodity prices, especially to the upside, have a history of upending a lot of these kind of reports.
You know, Fatih Birol, who's the IEA executive director, we actually had him on the podcast. In the press release with the video that we linked to the show notes, he talked about the situation in Europe and that we do need oil and gas for now and that we need it from stable suppliers, and that he encouraged Canada to, you know, drastically reduce the emissions because he'd prefer that the oil and gas comes from a country that produces them in a clean way and is reliable. And he wants, you know, Canada to be a producer of the future. But he, you know, believes that we need to get our emissions down in order to establish ourselves as those preferred producers in the future. So I don't think there's any kind of message here. And they were very supportive, actually, of ongoing natural gas production from Canada and recognized the greenhouse gas emissions benefits as our goal is to be one of the lower intensity providers of LNG.
We'll see what happens. I mean, a lot of our oil, or pretty much all of our oil, goes to the United States. Some of it is being exported as it transits out of the Gulf Coast and goes to markets dominantly, from what I understand now, in Asia. But the vast majority of our oil and gas exported goes to the United States. And so again, I think that, you know, what happens here in North America in the course of the next few years is going to be highly consequential to what happens in distant places as well. Because, if you think back half a dozen years ago, what happened here in North America was the rise of the oil sands and then the rise of shale gas, shale oil, and so on. And that had profound effects globally. Now we've got a situation where all three of those are moderating in their growth, in fact, flattening out. The US is down by 1 million barrels a day. And this is having major repercussions. And so again, like, it's nice to talk about the 100,000 foot level 10, 20, 30 years out. But I think a lot of these kind of reports are going to have to be rewritten based on what happens in the next 10, 20, 30 months, not 10, 20, 30 years.
Okay. All right. Well, I will say I agree, but you can't get somewhere without a plan, right? And
I'm not debating,
you do need a plan about how you're going to get to 2030 and 2050. And in fact, by the way, there was a lot of recommendations made in this document. Every chapter for every energy type had their own specific set of recommendations, but there were some overarching recommendations at the beginning. I just want to talk about a few of those. One, which I think was dead on, is Canada needs a plan to get to net zero by 2050. And to meet the 2030 target. And it must be collaborative, working together with the provinces and territories. They stress this many times, and I think this is really important. They talked about that Canada is very unique in that our Constitution explicitly recognizes that the provinces and territories have rights over their non-renewable resources, and as well as forestry and electrical energy, and that Indigenous people have increasingly control over lands and resources. And that if Canada makes a plan that doesn't involve collaboration and get everyone on board, then this is never going to happen. And I think that's a really important point. The feds, in Ottawa can make these plans, but if they can't get the provinces on board, it's never going to happen. It's just going to be a bunch of reports that never come to be. So I do think that was really constructive, and I do think we need a lot more collaboration on working together.
I'm the first to promote collaboration, espouse collaboration. I agree. There's nothing you can disagree with in this report with respect to the need for collaboration and many other points. The thing is that very low oil prices or very high oil prices tends to increase polarization, especially in this country. And this is what I'm talking about. There are things that are happening now with very high oil prices, and it's going to almost create like a fiscal, again, polarization in this country. It actually, if we don't acknowledge what's about to come here and deal with it in the next near term, the collaboration that's needed for the long term is unfortunately less probable, in my opinion.
Yeah, no, for sure. The dynamics of when one group's making a lot more money than others can really affect the collaboration.
Yeah.
That gets to another issue. That was one of their overarching issues, is we really need to enhance the grid interconnections across all regions on electricity. Well, that sounds really easy, but it's just going to take a huge effort. And you can look at this Atlantic Loop as an example, which they actually document quite well if you don't know too much about it. It's a project that aims to transport clean electricity from Quebec and Newfoundland and Labrador to New Brunswick and Nova Scotia to displace their usage of coal. Well, the issue is it's pretty expensive. I think it's estimated to cost like $3 billion. And those provinces, New Brunswick, Nova Scotia, are going to have to pay big fees to support this transmission line. And is that the cheapest source of energy?
We tend to think the politics of oil and gas are harsh. The politics of electricity from province to province and then cross-border state to state and all these interjurisdictional electrical interconnects. The politics around that are highly uncollaborative, actually. So, great recommendation. But if you actually get down to how are we going to overcome that collaboration, what are the solutions to do so, that's actually kind of lacking in the report. We've got to figure that out.
With that, I'll leave it to our listeners to read the rest of the report. Tons of recommendations there around efficiency, around how we're going to get to the net zero emissions cars by 2035. We have no plan to do that. We basically don't have a plan in most of these sectors, and that's really what the main takeaway is for me. And the other big bottom line is we just got a whole bunch of work to do if we're really going to make this happen in Canada.
Yeah, I think so. Look, it's a good report. It's good to plan. It's good to strategize, but it's also good to realize what's happening in the here and now, and that the plans are a dynamic thing as we deal with all sorts of known unknowns as we go forward into this decade. And the known unknowns the geopolitics, this upward bullish price cycle for the traditional energy commodities. I mean, these are movies we've seen before. So hopefully we can also go back in the past and learn from that and learn not to make the mistakes of the past going forward into the future. But maybe we'll save that for a later podcast.
Thank you for joining our podcast. If you enjoyed this podcast, please rate us on the app that you listen to and tell someone else about us.
For more ideas and insights, visit arcenergyinstitute.com.
Thanks for listening to this special rebroadcast of ARC Energy Ideas on energy versus climate. We'll be back next week with a new episode looking at natural gas use in homes. Until then, if you'd like to support our show or subscribe, check out energyversusclimate.com and leave us a review wherever you listen.